Hey, what's up, guys? It's Ezekiel Chiu here. So, let me ask you, do you know how powerful pullbacks really are in trading? They are not just a part of, say, most strategies. They are a game changer. So when you understand and when you master pullbacks, because pullbacks are pretty much in every chart itself, you are now adding a tool to your trading arsenal that you can use anytime the market shows you an opportunity, which is like all the time. All right. So today I'm going to show you just how effective pullback trading can be when done the right way. Right. We will break down the key strategies, how to avoid the common mistakes that most traders do. And then we're going to explore how to trade pullbacks in different market trends. If you're ready to level up your trading skills, this is the video that you want to watch to the end. First off, what is pullback trading and why does it work? So pullback trading, in essence, what you're trying to do is to buy the dips, buy the retracement, buy the correction in an existing trend. For example, if the market is trending higher, you're looking to buy the dip, right? Buy the retracement, buy the pullback, right? That's why it's called pullback trading. So this works when the market is trending. It doesn't just shoot up like a rocket. So it has its ups and downs along the way. So in an uptrend, you usually see prices making higher highs and higher lows. Now, as a pullback trader, your goal is to enter the market when there is a temporary dip or correction. Number one, you only wait at the support and resistance level. Okay, so what do I mean by this? Right, let me give you an example. If you take a look at this chart, you notice that the market is in a downtrend, which is marked by what? Lower highs and lower lows. What many traders tend to do is they mark their level around this point, roughly here. You can see that previously at this level, price acted as a support multiple times before breaking down. So now that this is broken, the support level is likely to turn into what? Resistance. So then traders will wait at that area. Then wait for what? Potential reversals or price, say, reactions. The problem with this approach is that you are solely focused on trading around this specific level, that you might miss out on other trading opportunities. The market might not necessarily retest that level. Instead, what could happen is that and you see it a lot of times, is that it just make a brief pullback, a little pullback, before continuing its downwards movement. So when that happens, that's where you go like, I just missed yet another opportunity, right? I should have anticipated this. So maybe I should have jumped into the market, right, etc. So the reason for this kind of frustration is that you are relying solely on identifying one area of value, which is just the support and resistance level. However, right, there are more to trading than just that, which I'm going to explain in a while. So let me give you another example. Take a look at this chart. You'll see another market that is trending upwards. Now, when traders look at this chart, they recognize what? This is in a what trend? An uptrend. So for someone who is a trend trader, the strategy is pretty simple. When a market is in an uptrend, they look to buy or sell, to buy. But where exactly do they look to buy again? They solely focus on one particular area of value, which is where? The support level. So based on this chart, how many times the price test or retest this support area? You see this chart, there are not any chance to buy at the support level. So this should make you realize that trading pullback involves more than just looking at support and resistance. So I'm going to explain later on what else you should consider. Now, here's the second mistake. You enter your trades too early. This is going to be another common error. You try to time the pullback thinking, right, oh, the market is approaching my pullback zone. And then suddenly you buy. but the market drops further, right? It drops sharply. So what happened? You entered your trades what? Too early. Let's take a look at this example. You can see how bullish the market is, right? Price broke out of the resistance level, made a pullback, and the most recent candle has closed higher for the day. So now at this moment, traders might miss the trade because what? They are eager to jump in. They see the pullback seemingly ending. It's kind of like going to end. So now they what? Let's go and buy, right? They rush to buy. However, when they buy at this price, and then they wonder why they get stopped out of the trade. Why is that? I'm going to explain it to you. But this is a mistake that traders make when they trade pullbacks. They enter their trades too early. So now, let me give you another example. If you see this one over here, the same thing. The market essentially broke below this support area with a strong bearish momentum, correct? So then we observe a couple of candles pulling back here and here. Now, consider this specific candle. At one point, if you imagine, right, it was trading near the lows. And then the closing price ended near the lows of this candle, indicating what? There are some bullishness despite the initial bearish momentum. Now, before the market closed, it formed a red bearish candle. So many traders got excited, thinking, oh, the pullback is ending. Look at how red this candle is. It's time to short the market. So now they enter their short trades, and then what happened? They entered it too early, and then what? They get stopped out again. So now, this is the mistake that a lot of traders make, entering their trades too early when trading pullbacks. You now understand the mistakes to avoid. It's either solely focusing on support and resistance level, or entering your trades too early. Now, let's explore how to trade pullbacks effectively. The key thing that you must know when you're trading a pullback is to pay attention to the market structure. Now, I cannot give you a full lesson on market structure. We will just talk about market structure in a trending market. Now, here's the thing. Not all trends are created equal. Some markets are in a strong trending behavior. Some are in a healthy trend. Some are in a weak trend. So, let's focus now on a trending market. So let me point out the subtle difference for you. Okay, in a strong trend, price typically remains, okay, so that's where we can use moving averages, above the 20 period moving average. So now we use this as a guide. We use the 20 moving average as a guide, whether is it an uptrend or while in a downtrend. Price tend to stay below the 20 period moving average. So in the uptrend, it stays above. In a downtrend, it stays below. This is a strong trend because the 20 sticks very closely to the price. Now, in a healthy trend, price often retraces towards the what? This is where we give it more leeway. Towards the 50 period moving average, meaning it's the average of the last 50 bars. So now, in addition to an healthy trend, the market tends to retest previous resistance level that could potentially act as support, and then vice versa for a downtrend. So now, this is a healthy trend. In a weak trend, this is like the weakest one. Pullbacks are usually very steep and deep. They often find support or resistance at the what? At the 200 moving average. So the average is now the last 200 bars, meaning the trend is pretty weak, or at previous support and resistance level. So now let's take a look at some examples to illustrate the points that I just shared with you, okay? So once you understand the concept of a trending market structure, this is where I'm going to assure you that your approach to pullback trading will never be the same again. So first one, let's take a look at the example of this pair. As we discussed earlier, many traders are waiting for what? Are waiting for the previous support level. They expect it to become a resistance. However, with an understanding of the market structure, you will realize that this is not the only area of value to trade from. You can see, and that's where you can trade other types of area of value, such as the 20 period moving average, right? The 20 MA. Okay, so why the 20 MA? Because if you observe the market trending structure, it's currently in a strong downtrend, consistently remaining, right, and maintaining below the 20 MA. So it has tested 20 MA once, twice, and even thrice. That's where it further confirms its importance as a level of resistance. So at this point, I wouldn't be looking to sell in this area of resistance. Instead, I would be focusing on the 20 moving average. The market has now given you clues that it respected the 20 MA. So that's where I'll be watching for potential entry points. You see, it tested once, twice, and now it's back at this area again. So now the 20 MA becomes the key area that I'll be focusing for trading the pullback. So now, how can I trade the pullback? Number one, what you can do is to look for a bearish price action at the 20 moving average. Okay, so this could appear as, say, a shooting star or a bearish engulfing pattern. For example, the market breaks out higher and then it suddenly reverses near the lows and closes lower for the day itself. Now, forming a bearish candle with a long wick sticking out. So this indicates what? Price rejection, and it suggests what? That the buyers struggled to push the price upwards and then the sellers took control and then pushed the price down to the lows of the day. So when this happens, right, you can what? You can look to sell at the open of the next candle with your stop loss placed above the high of this bearish rejection candle. Another approach is what I call the break of structure. If you switch to a lower time frame, like the 2-hour time frame, you're gonna notice that currently the price is being controlled by the buyers. Okay, so now how do I know that? Well, you can observe a series of higher lows and higher highs. So at this point, it is still forming this series of higher highs and higher lows. I don't want to sell the market just yet because what? The buyers are still in control. However, one thing I do know is that on the higher time frame, such as the daily time frame, as we've seen earlier, the trend is towards the downside. So now in addition, we also noted earlier that the price is at this area of value, which is the 20 MA. So what I can do is in, say, the 2-hour time frame, I can use this time frame as an entry trigger to enter the market. The entry trigger could be as simple as a break of structure, or where the price forms a series of lower highs and lower lows. So now here's another possibility. The market can drop lower, then bounce up. So now if price breaks below the previous lows, okay, showing what? A series of lower highs and lower lows, it suggests what? The sellers are now likely to push price where? Down further. So considering that we are already in a downtrend on the higher time frame, this is now a good signal to short the market, timing the pullback. Does it make sense? Hopefully, this strategy is clear for trading in a strong trending market. Now, what about a healthy trend? If you look at this again, if traders were to wait at the previous support level, they probably wouldn't find too many trades because what? The market didn't retest those areas. So how can we trade this market? First off, you want to determine the current market structure. We know it's in an uptrend, but we got to be more specific. What type of uptrend it is? What is the current trending market structure? As we said earlier, right, there are 3 types: the strong, the healthy, the weak. One way to find out is to let the moving average be our guide. So if you pull out the 50 moving average, you're going to notice that the market tends to respect the 50 moving average. All right, so the depth of this pullback is steeper and deeper than what we have seen earlier on the above chart pair earlier. This has respected the 50 MA multiple times. Once, twice, thrice, 4 times. So if you ask me, there's a good chance that the market could find buying pressure at this moving average. And if you also recall, I mentioned earlier that for a healthy trend, you can also find trading opportunities at previous resistance turn support. If you look back at this chart again, you will notice that in a healthy trend, previous resistance can now potentially act as support. Now, I want to buy or to trade this pullback. I'll be looking at this area around this level. The entry trigger is pretty simple. We can look for a bullish price rejection, like say a hammer candlestick, or we can look for a break of structure on a lower time frame. Maybe say the 2 hour or the 4 hour time frame to time our entry and trade this pullback. All right, does it make sense? Here's another one. All right, let's look at this market structure. If we look at this market structure of this pair itself, what is it? Is it a strong trend, a healthy trend, or a weak trend? If you look at things, and if you just zoom out a little bit, it appears to be a what? A weak trend. Because the historical pullbacks have been pretty steep, isn't it? So for a weak trend like this, where is the area of value? Right? It's not going to be the 20 moving average. It's not going to be the 50 moving average. Where we are looking for trading opportunities will be what? It will be at the support and resistance area. So in summary, this is a weak uptrend. You're going to look for buying opportunities at the area of support. And sometimes in a weak trend, you can also look for buying opportunities at where? The 200 moving average. Let's see whether the 200 moving average holds up. You see, it has been tested pretty much. This is like 1 time, 2 time. So again, around the 200 moving average, around this area of support is where you can look for buying opportunities. So this is where you wouldn't be using the 20 MA or the 50 MA because clearly the market doesn't respect these moving averages. You have to understand the market structure. And then when you do that, that's where you know which are the areas of value to look for trading opportunities. Does it make sense? So let me walk you through a couple of entry triggers again, because I think this is important as well, right? When you're trading the pullback. The first one, the initial entry trigger that I mentioned earlier is to look for a bullish price rejection in an uptrend. So let's say the market heads lower, forming lower lows, and then it forms something like a hammer candlestick pattern. This is a bullish signal. So this indicates what? The buyers are now stepping in and willing to what? Push the price higher. Okay, so this suggests that the buyers are what? They are likely now in control. Okay, so this is what we call a false break, where price tends to what? It break below the area of support only to close back higher above the support. This is like the best kind of price action at the support level. It tries to break, it couldn't, pushes back up. It shows that the support level is really strong. It shows that there's very strong price action over there. In this case, you can enter a long position when the next candle open with your stop loss placing it below the lows of this hammer candlestick pattern. Right? That's one way. Now the other approach is what we call the break of structure. You will go down to a lower time frame, look for the break of structure. Right? Say for example, we switch to a 4-hour time frame. Now, if the market were to retrace down lower to the area of support that we saw on the daily time frame, it will look something like this, right? A series of what? Lower highs and lower lows, something along the line, right? Now, when we are looking for a break of structure, you want the market to reject its current pattern of lower highs and lower lows. So you want the market to change, right? Change the pattern. Instead, you're seeking for a pattern of what? Higher highs and higher lows now. So this could be various forms. So now you see, now we are showing you overall pattern. It could be like, say, the inverse head and shoulders pattern, or ascending triangle. So when you understand the concept, all these patterns doesn't really matter. So in simpler terms, right, imagine the market consolidating, forming whatever patterns it may be, forming a neckline that acts as a resistance. So now if price breaks above that level, it signifies a shift to higher highs and higher lows. Okay, so that is why understanding of how the pattern works is more important than memorizing the pattern. So this is like one variation of it, resembling what? Like a inverse head and shoulders pattern. So if price breaks above this resistance line, now you have what? A series of higher highs, higher lows. So this is where you can see, right, the concept is what matters here. Nothing about specific patterns or technical analysis, is understanding the concept. I hope that makes sense. Okay, so now with that said, let's recap. Number 1, pullback trading involves buying dips within an uptrend by buying at lower prices with the expectation that the price will continue upwards, right? So this strategy works because trend rarely moves in a straight line. There is often pullbacks, right, before resuming the direction. This happens in all markets itself, all pairs itself. So when you enter at all these pullbacks, you can place yourself in a position for potential profits as the price trend tends to resume the original direction. So number 2, the market can pull back to various areas of value, such as the support and resistance level, the moving averages, trend lines, etc. So they are all potential entry points for pullbacks. Number 3, avoid entering your pullbacks trades too early. Instead, wait for the price to come to your identified area of value before you consider entry. So this helps to ensure that you are trading with the trend and entering at favorable levels. Number 4, understand the market structure. So determine whether the market is in a strong trend, a healthy trend, or a weak trend. In a strong trend, the market tends to respect the what? The 20 MA. In a healthy trend, the market tends to respect the what? The 50 MA. In a weak trend, the market tends to respect the what? 200 MA. So depending on the market structure, that's where you can find trading opportunities at various levels, such as the previous support and resistance level for healthy trend, or support and resistance level for also a weak trend. Right? And then finally, you can identify multiple areas of value. So the market structure is always changing. So you should not be like fixated on just one area. Look at multiple areas of value so that if one area gets, like, say, invalidated, such as a breakout, you know where else to look for trading opportunities. So when you are this flexible, right, the flexibility allows you to adapt to the changing market conditions. And then you can find opportunities even when your initial setup is invalidated. So thank you so much for watching. If you enjoyed this video, please give it a thumbs up, right? It really helps to keep the channel growing. And if you are new here, don't forget to hit that subscribe button and turn on the notification bell so that you never miss an upload. So we also love to hear from you, right? Drop a comment below and let us know what you think or what you'd like to see next. I mean, your support truly means the world to us. It keeps us motivated to bring you awesome content every week. And if you're keen to learn more, I've created a free 5-part comprehensive training where I show you exactly how I trade using my lifestyle method. Link in the description below.